Welcome back, folks. In this short video, I want to break down two of my trades that I did on the NASDAQ on Friday, 27th of June, 2025. And that is this trade here that I have already posted on my Twitter profile and also in my YouTube community post section. This is the market maker sell model on the NASDAQ, okay? And this long setup trade that I executed, which I haven't posted anywhere, okay? Now, if you stay to the end, you're going to learn a very important algorithmic signature that hasn't been spoken about by many of the teachers out there. Okay, so firstly, let's talk about the short that I took, and that was this particular trade. Okay, now this is the video that I typically do for my VIP students. Okay, so this is the type of learning that they get access to as I post different types of videos depending on the different types of trades that I execute on various markets. Okay, so how do I identify a market maker sell model? Well, you need to identify first the original consolidation, where there are relative equal lows, right? You can see there's relative equal lows under that original consolidation, okay? You need to see some level of reaccumulation, which is pretty clear there. There's accumulation occurring there. And then you're looking for some kind of reversal where there's a top formed, takes out some liquidity. In this case, that horizontal line here is a weekly high, okay? You can go to your charts on the NASDAQ and look at the weekly chart and you'll see that is a weekly high. At which point, we can expect a reversal or a breakout, pullback and continuation. But in this case, we can see we have a false break reversal, and that is the smart money reversal. And you can see there are bearish signatures that are forming there. Okay, that forms the trade idea to take that short. Now, if we look at where I shorted from, you can see that I shorted inside of that level there as the market was pushing up. Okay, and coming up into the inverse fair value gap on the left hand side after seeing this smart money reversal, after it's taking out the weekly high, as I've indicated, and seeing this accumulation and the original consolidation, which is where I'm expecting to be the draw on liquidity. Okay, so you can see that once we have that smart money reversal, okay, we have the candle going up, right? And then this candle going down. Nice displacement. And this is the candle that I shorted on, okay? Expecting there to be a movement down into where? Down into below that level, which is the original consolidation. Okay, now on this particular day, which is Friday, I'm actually bullish. Okay, so this short is a bonus trade for me, and what I am looking for in a bullish market is the initial manipulation down. Okay, so that movement down was the manipulation, although an opportunity to short because we do have a pattern there, a setup, right, to short from here down to that level. But that movement down is designed to get short sellers into the market, and it's targeting liquidity resting below that consolidation because the market needs liquidity for the original move up. Okay, I'm biased to the upside on the day because higher time frame we are bullish, and we are bullish because on the weekly chart we can see that the market is expanding higher. More importantly, when we think about bias, we ask two questions: where have we come from? We've come from a weekly order block. Okay, we've also come from taking liquidity on the daily chart. If I look at the daily chart, you can see we have taken those equal lows on the daily chart. Okay, these equal lows, right there. So those equal lows. Okay, and that means we've swept liquidity and we're moving up, right? And the weekly time frame shows us the same. So where have we come from? We've come from a weekly bullish order block. Where are we going? Well, we have relative equal highs on the weekly time frame, which is going to be the draw on liquidity. Okay, so these highs up here. So where have we come from? We've come from a weekly bullish order block. Where are we going? We're going to these highs. Okay, so high time frame I am bullish, and therefore I'm looking for longs. Okay, but for the market to move high, we know the market first needs to manipulate, right? And this movement down is the manipulation, takes out sell side liquidity to then attack engineered buy side liquidity. So the market needs to have liquidity on both sides. Okay, now I want to drop into a lower time frame to talk about the long setup. Okay, now remember, I'm not talking about these in hindsight. Okay, this was the short that I had executed, right, which was targeting the stops under this original consolidation. Okay, sell stops and needs liquidity to move back up, and then I took the long trade after the sell side liquidity was taken to attack the buy side liquidity, and that's in alignment with my directional bias as I've spoken about. Okay, so what do we see? Let me now jump down to a 1 minute time frame. So here is the move down, okay, and these reference points, right, the purple shaded area is a fair value gap. The red line is the liquidity resting below that original consolidation. Okay, so we drop down to a 1 minute time frame. Time is what's important here. Okay, so I'm going to just zoom in because this is how you're going to get better, right? You've got to practice entries. So it's time. Time's important. 9:30 a.m. is the New York Stock Exchange open, right? That's when you will find an injection of volatility, and that's when you'll find the best setups, okay? Anything before that is just engineered liquidity, okay? So you can see the market, if you look at these two down candles, comes and takes liquidity. Those two down candles are the bullish order block when we trade above. You can see on this candle, we trade above. Okay, the next two down candles on this 1 minute time frame come down into the bullish order block and the fair value gap, and that is the perfect place for an entry, right? You can see you get expansion again. This candle moving down is now coming into this bullish order block, right? So the market's giving multiple opportunities for entry long. We also have a bullish breakup. We have a low. Okay, let me just mark this out for you, right? So we have a low, we have a high, we have a lower low. Okay, so if we expand that section there, you can see the market is coming into that bullish breaker, right? So we have multiple convergence of signatures telling us that the market is now changing its state of delivery and is going to now deliver the buy program, okay? And that is the classic market maker buy model, right? So we have these two down candles at the order block, takes liquidity. That red line, if you recall, is this red line here, right? Beneath that consolidation, okay? So let me make this bigger for you so you can really see it. You've got to go back and you've got to study your charts. That's how you're going to get better, okay? So we go down through that liquidity, immediate rejection, right? These two down candles come into those two down candles, which is a bullish order block, fair value gap, immediate rejection, and this is now coming back into this newly formed bullish order block as well as the breaker, this up close candle, right? We have a low, high, lower low, expansion, moving down into these two down candles, order block, and the bullish breaker, okay? And the obvious target is going to be back above these highs, okay? So the short under the consolidation was a target, market maker sell model, and the long was the market maker buy model back up to the buy side liquidity. Now, there are additional setups here, okay? And for those of you who are still with me, this is going to be a secret algorithmic signature that very few have taught, okay? So we can see that now we've taken the liquidity resting above these highs, okay? So people who were short have their stops above this level, okay? And that means there are buy stops. Okay, so once sell side has been taken, the market then attacks buy side. Now, this could have continued as I was expecting, right? Based on the weekly chart, I would have thought this would have continued and taken the next liquidity pool, and it may do so next week. But what we can see on the 15-minute time frame is that the market does not make a new high and instead displaces lower. So then this down candle becomes our mitigation block. This would be a bearish breaker had this gone up and taken out this high. But because these sequence of up candles did not take this high, when we displace down, this down candle becomes our mitigation block. These three up candles become our bearish order block. But what do you see here? Now, I'm going to put a box around this large down candle, okay? And I want you to notice that we displace through there, but the market does not come back up, right? Usually what you want to see, and this is what ICT teaches, ICT says that this here, this down candle is our mitigation block because we did not sweep liquidity up here, right? These highs are still intact, so we did not make a new high. And then you're expecting the market to displace, pull back, and that's your entry to go short. But we can see there is no pullback to enter. Well, this is the secret that I'm going to reveal to you, okay? And this is the type of insight I provide inside of VIP, right? This type of information is usually what I only reveal to students inside of my VIP. Now, see this candle here? This candle goes all the way down and reprices up, right? That repricing up coming inside of that zone is enough for redelivery into this down candle. And so the market does not need to come back up to that level, okay? It's already done that with this delivery. That's enough. And that also allows that fair value gap to be a breakaway gap, which is what we want to see for the market to be heavy to the downside, okay? So you need to journal this and make some notes. When you have a bearish breaker or mitigation block and the market goes down, okay, if you get on that same candle that displaces through that price point, coming back up into that range, right, into the range of that mitigation block, that down candle, right, that is enough to deliver into the breaker. We don't expect there to be any further retracement into there. And it's more powerful to see this fair value gap left open at the breakaway gap, okay? And so this time, you can see the market goes straight down and takes the original sell side, okay, and sell side lower into the order block, okay, and fair value gap. Now, I want you to also notice this yellow box. What is this yellow box? Well, that yellow box is, if we go to a daily chart, there it is there, right up here, volume imbalance, okay? Always mark out your volume imbalances because they will offer entry or exit levels, support or resistance levels. You can see how the market has used this to push higher. So going back to our 1 minute, 50-minute time frame, on this move down, we go through the volume imbalance, and notice the next candle uses that as resistance to push lower. Take out sell side and enter into the discount PD array lower. Okay, now it's about time. Okay, what time does the market turn around? 3 p.m. Right, 3 p.m. is a key time in the afternoon session to expect a turnaround at a key discount PD array. Okay, so you got to go back and you got to study these charts and identify the algorithmic signatures. Okay, so I've walked you through the initial short that I've taken on the market maker sell model, the buy that I've taken on the market maker buy model on the same day on the same market. Okay, and I've also walked you through additional setups which I did not take, right, because this was enough for me, down and up, and these were additional setups that were also available. But the key lesson here is about this breaker. Okay, there should be an eye opener. So if you see a breaker or mitigation block, price does not have to redeliver into it if you see redelivery on the candle that has displaced through that PD array. Okay, so remember, this is the candle I'm referring to. Okay, and notice the time, 1:30 is a key time in the PM session to expect a major move, right? Injection of volatility. So this candle goes through the breaker or the mitigation block in this case, redelivers up, and that's enough. Okay, and then continues to reprice lower, attacking sell side here. Okay, sell side here, and coming into discount. And you can see that 2:30 is also 2:30 p.m. a key time where we've gone through the volume imbalance, and the volume imbalance is used as resistance to reprice lower. Okay, you can see on the way up, the volume imbalance is used as support to reprice higher. Okay, now let's take a look at the 1 minute time frame for how we may have entered this market on this reversal at 3 p.m. afternoon session. So let me jump down to a 1 minute time frame, and this is the area, right? So that's the discount, okay, PD array, and it's all about time, right? Time's important. So what do we see here? We see that the market is coming into discount, okay, and we want to wait for the new hour, right? So this is 3 p.m. So you can see we've moved down into this zone after taking liquidity, okay, it's 3 p.m. This down candle that's taken liquidity, this large down candle, is our bullish order block. So we want to wait for price to move above that level and push down into it, okay? So we can see that as we're moving up, we're starting to move up, okay? This down candle, right, at 305 is pushing into this down candle, which is a bullish order block. Okay, now we have multiple chances to enter because we have multiple bullish ICT signatures that have been formed, allowing us to enter, right? So we can enter here on this move down into this down candle that's taken liquidity, becoming our bullish order block. Okay, we displace up. These two down candles are also coming into this fair value gap. Okay, we can enter there, right? That's also in that first 10 minutes of 3 p.m. Okay, we can also see we form liquidity here. We move up, and fair value gap. So come down into fair value gap and the bullish order block, right? This is now the second 50-minute candle of 3 p.m. So lots of different chances, opportunities to consume into a long position, right, and to accumulate. Okay, now where would be our target? This is a market maker buy model, and what we want to do is we want to look for some kind of equal highs, right, where we could offset our long position. You can see very clean equal highs resting here. Okay, so when we are engaged in a market maker sell model, we are looking for equal lows to offset our shorts. When we are engaged in a market maker buy model, we're looking for equal highs to offset our longs. Okay, so if we go back to this chart, right, when I was short, my target was beneath the original consolidation, equal lows there, okay, from this level, okay, just down to those equal lows. So when I'm long, then I am looking for equal highs in a market maker buy model. Okay, so you can see that's why the exit will be there. Okay, entry from this section. Okay, from discount, which is that discount PD array, right? Using any of these ICT bullish signatures to get in to offset at equal highs. Okay, so you've got to go back and you've got to study these charts, right? That's how you're going to learn. And more importantly, it's time, right? Time than price. So this is all happening in the new hour. Okay, at 3 p.m. That's the PM session. Trade back up to target. Liquidity resting above the market, okay, where people are shorted from. So targeting buy side liquidity, okay. And on this side, right, if I look at the short, okay, we are targeting these equal lows, right? We are targeting folks who have sell stops beneath that consolidation for long positions, okay. So study the charts, study the time, right, and the long entry for the market maker buy model, right here in the New York AM session, is also time based. Okay, this is all happening at 9:30, right? The long that I've taken here, it's all at 9:30. Okay, so the 9:30 long, 3 p.m. long, okay? And this, I think, this short was somewhere also at around, maybe that was 11 a.m. So everything's time-based. You've got to go back and look at the time, study the charts, identify the signatures, okay? Hope that video is useful. Your job is to go back and study this chart to learn, right? I've pointed out some key elements of what you should be looking for. Your job now is to go back, study the charts, to learn, look at time, look at the signatures, look at the liquidity pools, right? So that you can identify this next time when this is happening in real live price time, okay? And your job is then to paper trade it, demonstrate it, to try and learn and see if you can engage with price and be able to correctly identify the signatures at the right time and correctly forecast where price is headed next, okay? Hope the video is useful. I will now talk with you in a future video.